Welcome once again. My name is Christopher Neufeld with Neufeld Legal, and this is our continuing YouTube video series on business law and incorporation. And in this particular YouTube video, we will be looking to discuss the differences between the two primary share classes, that being common shares and preferred shares, otherwise known as preference shares or special shares. With respect to common shares, to start off with, common shares carry at least three rights: the right to vote, and so as to exercise control over the direction of the business enterprise being undertaken by the company. Secondly, the right to receive a share of the profits of the company in the form of a corporate dividend. And third, the right to receive a share of the capital of the corporation, whether the company is wound up or dissolved. This typically being considered the equity portion. The basic equity component of the capital structure of every corporation is its common shares. It is the most fundamental of the shares, and when not defined, typically the one class of shares that every company will have is common shares. The owners of the common shares, meanwhile, will lose their investment if the corporation fails and obtain, but at the same time, they have the opportunity generally to obtain the greatest reward if the corporation succeeds. The holders of common shares typically have no expectation of ever receiving a return of capital unless the corporation is liquidated and sold. The only way in which a common shareholder will realize on the investments is by way of the sale or other disposition of his or her shares. Common shares are therefore considered the only true form of permanent capital. So what are the advantages and disadvantages associated with common shares? The principal advantage of common shares can be listed as follows. They are permanent capital. The company is not obliged to repay the capital for the common shares while it is a going concern. Common shares do not necessarily carry a mandatory dividend requirement. A strong common share base will increase the borrowing capability of most corporations, because it improves the corporation's debt to equity ratio, which is so critically looked at by the banks. Common share financing does not require the acceptance of debentures, trust indentures, or preferred share conditions. Typically a very straightforward process without the modalities and challenges associated with preferred shares or special shares. Finally, if a public distribution does occur, it is easier to obtain a reasonable estimation of the true value of the corporate enterprise, as market forces tend to determine the price for common shares. Nevertheless, there are some disadvantages associated with common shares. This includes the fact that the owners are forfeiting some measure of control when they entertain the aspect of having common shares. Secondly, the participation features of common shares will necessarily dilute the per share value of the common shares held by existing owners of the company. And finally, as more shares are sold, power is diluted away from the original investors or founders and the board must take into account minority shareholder rights. Some degree of flexibility and adaptability is lost as common shareholdings increase. The new shareholders may vote for a different constituted board, leaving the original investors or founders without any or much direct control over the corporation's future processes. Now, as an alternative to common shares, we have preferred shares, also sometimes known as preference shares or special shares. Now, preferred shares differ from common shares in that they usually carry no voting rights, but instead are paid out before common shares in the event of bankruptcy or other forms of liquidation or dissolution. The makeup of a preferred share is dependent on the corporation issuing them, and as such need to be properly structured, and this provides a degree of flexibility to preferred shares in that they can be tailored to meet the particular requirements of the corporate issuer, meaning generally the original shareholders and or its board of directors. Meanwhile, the purchaser is one of the principal attractions of preferred share financing, subject to certain minimal statutory requirements. The only limitation on the attributes of a preferred share is the ingenuity of the individuals designing it. Hence why lawyers typically are involved in the process of designing preferred shares and structuring them to meet the actual intended purposes of the corporate owners. A preferred share need not carry any particular preference over common shares to be properly characterized as a preferred share. Any preference in respect of voting, dividends, return of capital, or any other rights will make a share a preferred share. Preferred shares are generally thought to be a hybrid between pure equity, which is a common share, and pure debt, which is a debt instrument, typically such as a loan. Accountants, meanwhile, treat preferred shares as equity, without distinction from common shares. Lawyers, however, treat them much differently, because they focus on more than the accounting attributes. Now, let's look at some of the advantages and disadvantages associated with preferred shares. As to advantages, there's the flexibility afforded by preferred shares in comparison to common shares, such that the corporation is able to tailor them to provide for different offerings depending on market conditions or the particular requirements of the purchaser. This often makes preferred shares more sellable than common shares. Next, unlike an issue of common shares, preferred shares typically do not dilute the voting control of the existing shareholders unless the preferred shares have voting rights attached to them, or if they are convertible into common shares. Another advantage is that preferred shares do not involve any obligatory drain on cash resources, as would be the case if financing was secured by debt. And unlike debt, preferred shares, unless they bear a retraction privilege, do not require a return of principal. Finally, preferred shares attract different tax treatment than dividends or interest on debt. The rate of return of dividends is generally less than the prevailing interest rates. If the company does not have much debt, the cost of preferred share financing may be lower than loan or debt financing. Conversely, interest payments are deductible, but dividends are not deductible. So a company with higher debt loads may prefer to use financing over dividends. Meanwhile, there are disadvantages associated with preferred shares. Fixed dividend obligations often attach to preferred shares. Next, preferred shares will normally rank in priority to common shares in respect of the payment of dividends and the return of capital on dissolution, something that the common shareholders need to be aware of. Next, the net asset value of the common shares will be reduced on an ongoing basis by the amount of paid up preferred shares. Next, most preferred shares have to have a maturity or retraction privilege to make them marketable, unlike common shares, which represent permanent capital. So these are not necessarily permanent capital. Remember that. Next, in order to make them marketable, a corporation may have to make the shares convertible into common shares, which will then dilute the equity in the company. And a final disadvantage, though not necessarily all, is that the spread between the dividend rates on its preferred shares and its debt service requirements will usually be insufficient on an after-tax basis to compensate for the deductibility of dividends. Now, these are just some of the advantages and disadvantages associated with the different share classes, but it should provide you with some sense of understanding of what each of these share groupings represent and where they can be directed to assist your business. Naturally, it's always recommended that you take advantage of experienced and intelligent accountants and lawyers when developing these structures, especially when you are looking to grow the business and to generate significant advances for yourselves. Because simply issuing varying types of shares with no proper understanding of the ramifications associated with each type of share and what is contained in a specific share class can be highly problematic and financially costly if it is done improperly and without sufficient understanding as to the ramifications. Hence, the importance of having knowledgeable professionals involved in any such process. Hopefully you have found this YouTube video informative. Please like our video, subscribe to our YouTube channel, and provide us with your comments. And should you be seeking paid legal advice, feel free to contact ourselves, as that is what we are here to do at Neufeld Legal.